Welcome to this explainer. Today, we're going on a seriously fascinating journey into the hidden mathematical order of the financial markets. We're cracking open the ultimate Traders Toolkit, pulling straight from Chapter 3 basic principles of trading strategies laid out by Robert and Jens Fisher. If you've ever felt like the markets are just completely unpredictable, well, what we're about to cover is going to change your perspective entirely. We'll be looking at 4 foundational tools that actually reveal the underlying structure of price movements.
You know, a lot of people feel the exact same pain when they look at a financial chart. It feels like staring at a chaotic casino where literally anything can happen, right? But what if I told you that market chaos is actually just an illusion? The truth is, markets are driven by human emotion, specifically fear and greed. And the beautiful thing about human behavior, it repeats itself. It leaves these predictable visual footprints right there on the chart. Once you know exactly how to spot those footprints, the chaos starts to look a whole lot more like a blueprint.
And hey, this isn't just some abstract theory. As the authors of our source material note, and I think this is a really powerful thought, computer models have yet to prove that they can consistently outperform pattern recognition as an analysis approach. Even with all the supercomputers and wildly complex algorithms out there today, simply recognizing these deeply ingrained human behavioral patterns remains one of the most reliable, math-driven antidotes to emotional trading.
So here's our roadmap for today's explainer. We're going to start with the unifying concept of the magic figure 3, then move into Fibonacci analysis and targets, decode candlestick momentum, spot 3-point chart patterns, map trends with PHI channels, and finally, bring the whole shebang together in the synergy of systems.
All right, let's dive into Section 1, the magic figure 3. This is really the foundation of market footprints.
Before we even touch the complex math, we need to establish a unifying philosophy here. Human trading behavior naturally and repeatedly falls into patterns of 3. Why 3? Well, because it represents the natural life cycle of a market move. You've got a trend, a correction, and then a continuation of that trend. So where do we actually see this magic number? Honestly, almost everywhere once you start looking. It shows up as 3 waves and price extensions. You'll see 3 peaks and triple tops, 3 valleys and triple bottoms. It manifests as 3 rising valleys in an uptrend or 3 peaks in symmetrical triangles. By training your eye to focus strictly on these specific 3-point footprints, you effectively filter out the market noise. Sure, you might miss a wild random trade here or there, but your overall analysis becomes exponentially safer and way more accurate.
And as you can see here, whether you're looking at a wedge, a channel, or a triangle, that 3-point structure is essentially the skeleton holding the entire market move together. It's absolute proof that if you know what to look for, the supposed chaos of the market actually behaves just like structured geometry.
Moving right along to Section 2, Fibonacci Analysis and Targets. This is where we use natural ratios to predict price targets. So let's transition from the overarching magic 3 shape to the exact math that governs these waves. The absolutely crucial point here is the mathematical constant of investor behavior, the Fibonacci ratio, or phi, which equals 1.618. And this isn't just a random number someone made up. It's a natural mathematical ratio found all throughout nature, architecture, and yes, your trading charts. By applying this specific ratio to an impulse wave, which is just a strong move in the trend's direction, and the inevitable corrective pullback, we completely remove the guesswork from where a price is heading next. We're replacing, hey, I think it might go here, with precise, calculated target prices.
Let's actually see this math in action. Notice that 3-wave pattern on the left. You take the size of that first impulse wave, from A to B, and you simply multiply it by 1.618. Add that to the bottom of your corrective wave at C, and boom, you have a highly precise target price for point D. Then, on the right, you can see how this expands into a 5-wave pattern. You're layering in the reciprocal ratio of 0.618, which is basically the inverse mathematical relationship, to pinpoint the ultimate top of the trend. It's just beautifully systematic objective forecasting.
All right, Section 3, reading candlestick momentum, getting a read on daily investor psychology totally without the time lag.
Opening up our next tool, we're looking at candlestick analysis. If Fibonacci gives us the ultimate destination, candlesticks tell us exactly who is winning the battle between buyers and sellers right now, in this exact moment. When we examine the anatomy of a candlestick, you have the central body, which represents the opening and closing prices. Then you've got the wicks stretching out above and below, showing you the absolute highest and lowest prices of that session. A white or empty body means buyers pushed the close higher than the open. A black or filled body means sellers took control and drove it down. Just by observing the size of the body and the length of those wicks, human momentum and emotion become instantly visible to you.
And honestly, this is exactly why candlesticks are vastly superior for short-term reads compared to your standard bar charts. Traditional computer indicators, like moving averages, well, they always have a time lag. They're basically telling you what happened yesterday. But candlestick charts, they give you an instant momentum read. They alert you to trend changes the literal moment the psychology of the market shifts.
Which brings us to Section 4, Spotting Three-Point Chart Patterns. This is all about identifying exactly where trends finally come to an end. Because look, knowing the momentum is great, but knowing when a massive trend is finally exhausted is where traders actually survive and thrive. Here we see classic rectangular chart patterns. Notice how the price just bounces between those horizontal support and resistance lines. It's essentially the floor and the ceiling of the current price action. Now, the biggest trap for traders here is the false breakout, getting too excited and jumping in too early. The secret? You have to wait patiently for 3 distinct peaks or valleys before taking action. And yeah, you might occasionally miss the absolute bottom doing this, but waiting for that third point drastically reduces your risk of getting caught in a fakeout.
Here's another really common visual footprint, the three-point wedge formation. Just look at how points 1, 2, and 3 clearly define the contracting boundaries of the price action. This really re-emphasizes our core theme today. Successful trading is a highly strategic game of pattern recognition, not just wild guessing. When you see that third point lock into place, the market is aggressively signaling its next major move.
Next up is Section 5, Mapping with PHI Channels, literally drawing the boundaries of a trend.
For this, we are pulling out a highly advanced tool, Mapping with Phi Channels. This is how you can actually map the outer boundaries of a market's movement to forecast exactly where resistance is going to kick in. Let's break down this methodology so you can replicate it yourself. First, you establish your baseline by simply connecting the absolute bottom of a move to the top of its first major wave. Next, you frame that move by drawing an outside parallel line starting right from the valley of the corrective wave. Finally, you apply our magic Fibonacci ratios to the distance between those two lines to calculate your further parallel boundaries.
And the result of those steps? It creates what look like invisible, mathematical force fields. Look at those dashed lines stretching out into the future at Fibonacci distances of 0.618, 1.000, 1.618, and so on. These aren't just random lines drawn on a screen. They act as predictive boundaries. As the price moves over to the right, it naturally reacts to these channels, allowing you to forecast major changes in direction long before they even happen.
Finally, we've made it to Section 6, the synergy of systems. Let's talk about removing emotion completely from your trades. This is the climax of this entire approach. Using just one of these tools is helpful, sure, but combining all of them into a single synergistic strategy is how you take emotion entirely out of the driver's seat. Here is that synergy at work on an actual S&P 500 chart. Look at those precise entry and exit circles. Those are not generated by a single lucky guess. They happen when a 61.8% Fibonacci retracement aligns perfectly with a specific candlestick reversal signal, which forms exactly on the third point of a chart pattern. By waiting for all these footprints to overlap, you dramatically reduce your risk and multiply your probability of success.
So, the absolutely crucial point I want you to take away from this explainer today is this. No single tool is a magic bullet. But layering these footprints together, that provides a mathematical shield against your own fear and greed. By combining Fibonacci math, candlestick momentum, and three-point patterns, you can pre-calculate your entries, your exact profit targets, and your definitive stop losses before you ever put a single dime on the line. Which leaves us with one final, pretty provocative question. The math is proven. The system works. The visual footprints are right there on the chart for anyone to see. But do you have the discipline to actually sit on your hands, wait for the perfect alignment of 3 points, and follow the system? Because, in the end, mastering the market isn't just about reading the charts. It's about mastering your own psychology. Thank you so much for joining me for this explainer, and happy analyzing.